If you're planning to retire early, a critical part of your plans will be your investment strategy, and in particular, what portfolio will tide you through what could be decades of retirement without running out of capital. So in this video, we'll look at how to approach that problem and how to build investment strategies that will sustain you for a long period of time. Now, if you do want to learn more about investing, you can do that by signing up for our free weekly market roundup. We try to keep it topical and interesting, and to learn more about how to do that, click on the link beside me and in the description below me. So let's look at how to build a portfolio for early retirement in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. One way of thinking about your retirement portfolio is as the goose that lays the golden eggs. And of course, we all know the story about what happened there. The mistake that the farmer made when he had this amazing goose was to kill it. And of course, that's not what we want to do with our portfolio. We want something which will be able to last for a very long time, preferably forever, and that way it'll feed us for as long as we need the money. And by analogy, many investors see high dividend stocks as a way to generate an income without having to kill the goose or to sell off your stocks. You just buy the stocks, they generate an income, dividend payments, and that way you can live off the income without having to sacrifice the stock which generates them. If that's your strategy, then a good place to start is to think about how much dividend we'll need as income. For the sake of argument, let's just say that the income you require is $30,000. And if you buy a dividend-paying fund that pays a 3% dividend, then to generate $30,000, you'd need to invest $1 million, because 3% of $1 million is $30,000, and that's what you'd be paid every year. And here's one example of one of those high dividend paying funds. And the way this fund operates is to track a portfolio designed by FTSE Russell. And that portfolio is designed to specifically buy stocks that pay a high dividend. Now, the price of that fund as I make this video is just over $100, $106.81. And the way we calculate dividend yield is backward looking. We look at the last year of payments, which in this case is just over $3, and then we take that income and divide by the amount we'd have to pay to generate the income, which is just over $100. So in this case, the dividend yield is just under 3%. It's 2.8% at the moment. Now that will fluctuate due to two reasons. One reason varies very rapidly, and that's the price of the fund, which will change minute to minute. And the second thing which changes is the actual dividend payments, which vary much more slowly. You can see they're paid here on a quarterly schedule. So to use that fund that we just saw to generate $30,000 a year, we take our $30,000 and we divide it by the dividend yield, which is just under 3%. And because the yield is a little bit lower than 3%, we'd have to invest a little bit more than $1 million. Now you're probably thinking that's a lot of money to generate $30,000 in income. And you're absolutely right. We can do a lot better than that. But in order to do that, I think we have to use the right metaphor. The goose that laid the golden eggs is the wrong metaphor. The problem with a goose as a metaphor is that you can't eat a small proportion of it without killing the goose. But that's completely unlike a stock portfolio, because there you can sell a small number of shares without stopping the rest of the shares from paying out a dividend. What we should really be thinking about is total return. And that's a combination of two things: capital gain, which is when you buy low and sell high, and dividend is just another way of generating total return. And if we focus on dividend, then we're missing a big part of the return story. Now that's particularly true in the United States, where a big part of returns on stocks come from share buybacks. That's when a company buys back its own shares and actually concentrates your ownership of that company. And usually the effect is to drive up the stock price. For example, if you look at many of the largest tech stocks in the US, such as Apple, one of the things they use for their spare cash is to buy back their shares. And you can see what an incredible effect that's had on their capital gains. And in the US, for reasons of tax efficiency, a lot of the shareholder value is generated from these buybacks rather than dividends. So a broad US stock market index is the S&P Composite 1500, and the light blue line here shows you the percentage of net income from that index which comes from buybacks, whereas the dark blue line is the percentage that comes from dividends. And since 1997, buybacks have been a more important source of income than dividends. And that's why I think we should shift our metaphor away from geese to something like crops. So let's imagine that we own a small plot of land and we want to create a self-sustaining crop of maize. How would we go about that? Let's start off with 100 cobs of corn. What we could do is not eat any of that corn and just plant the seeds for next year. Now next year we might even have more cobs than we did this year. We now have 120 cobs. If that's the rate of growth of our corn portfolio, then we could afford to eat 20 cobs every year and plant the rest. And if we do that, we'll always have 100 cobs to plant and 20 to eat. So if we eat 20 cobs, that's our perpetual harvest rate. If we ate too many cobs, then we wouldn't have enough to plant for next year, and gradually the size of our crop will dwindle until it's not self-sustaining. If we eat too few of the cobs, then the size of our crop will grow. So really it's about finding that rate of consumption which doesn't deplete our crop. Now with that new metaphor in mind, we can introduce a perpetual withdrawal rate. Now for any portfolio, that's historically the rate at which you could withdraw money such that you'd keep the same amount of principal. So if you start off with $1 million today, you'd still have $1 million 20, 30, 40 years in the future once you adjust for inflation. So let's say we want a 40-year retirement period. We'd look back for a given portfolio for every 40-year period in the past, and for the worst period with the lowest inflation-adjusted returns, we'd work out the withdrawal rate, which would have just kept the pot the same size. In years where the return is better than that worst case, the size of our pot would grow. But that way at least we've designed for the worst possible scenario historically. If you're enjoying this video, why not like it, or even better, subscribe to our channel, and that way you won't miss any new videos. To explain that with a real example, let's just imagine we've got a single fund in which we're going to invest. And as you probably guessed, I haven't chosen this fund accidentally. This is a small cap value fund based on US stocks. And if you backtest this strategy, this one performs exceptionally well for having a high perpetual withdrawal rate. And the types of stock it buys are small cap stocks, so these would be small companies, which are also relatively cheap. There are equivalent funds you can buy in other regions, or you can buy funds which give you access to these stocks in the US. If we look at the value of $100 invested in that fund in 1930, this is how it would have changed over time. But what I've done here is I've adjusted down according to the rate of inflation, because the buying power of the value of that fund would have dropped dramatically as inflation erodes the value of money. And then what I did was to look at every 30-year period going back 90 years and found the worst period, which was between 1946 and 1975. And there are two reasons why the return was bad during that period. The kind of obvious one is that there was a big fall in equity towards the end of the period, and that was between the late 1960s and the mid 1970s. The blue line does not adjust for inflation during that period, whereas the red line does. And unfortunately, at the same time that equities took a tumble, there was also very high inflation. So if we don't adjust for inflation, the return was 9.5%, and if we do, it was just 6.1% over that period. And this is another example of why equities are a bad inflation hedge when inflation is very high, as I've mentioned in the past. The final step to work out the perpetual withdrawal rate is for that atrocious period of 30 years, what rate of withdrawal would have kept the pot the same size once we adjust for inflation. And what we do is to work out the initial percentage which we withdraw in the first year. And if that percentage is 4.08%, in the following year we take out a little bit more because it's inflation adjusted, because the cost of living would be gradually increasing over this period. So we'd have to adjust our withdrawal amounts to ensure we could afford to live. Now for the first half of this period, inflation just creeps up gradually, but you can really see it take off towards the end of the 1960s, such that by the end of the period, we are actually withdrawing twice as much as we did when we first started. But the key thing to understand here is that the perpetual withdrawal rate is just for the first year. So if we have $100 invested, we withdraw $4. And then every year after that, we simply inflation adjust the amount. And here's the inflation-adjusted size of our pot over that terrible 30-year period. And exactly as we wanted, it starts off at $100 and it ends up, at the end of the 30-year period, at exactly $100. And these are $1946, so it's been adjusted for inflation. Now notice that during the period when inflation wasn't too high, the actual size of the pot was growing quite considerably, and it peaked at over $300. But that was necessary in order to pay for the period when there was very poor equity performance and when inflation was very high. Now, of course, there could be even worse scenarios in the future. So all this really tells us is that for this investment strategy, it survived that worst 30-year period with the size of the pot intact. Now, if we did different portfolios, we'd come up with a different perpetual withdrawal rate because the historic returns would be different. So now let's look at how we'd actually build some of those portfolios for early retirement. A good starting point is this portfolio, which is called the Golden Butterfly, because according to how you plot it, it looks on a pie chart a little bit like a butterfly. The head of the butterfly is gold, which makes up 20% of the portfolio. Then we have 20% in long-term bonds, 20% in short-term bonds, 20% in the total stock market, where we're talking about the US stock market, and there's small cap value stocks again, which makes up 20% of the fund. Now, if you want to try any of this stuff out for yourself, a great way to do that is with portfolio charts. Just go to portfoliocharts.com and you can play with the calculators. And in fact, the creator of that website, who's anonymous, created this Golden Butterfly portfolio. Now, the number we're interested in is the PWR, or the Perpetual Withdrawal Rate, which for this investment strategy is a very high 5.3%. And as it says up here in the legend, the Perpetual Withdrawal Rate sustained its initial principal in the worst case. So we've chosen a 40-year retirement period here. Then the app looks back over every 40-year period since 1970 and it finds the worst 40-year period. Then it works out the withdrawal rate for the first year that would exactly have kept the size of the pot constant once you adjust for inflation. Now, what's also interesting about this portfolio is that the perpetual withdrawal rate is roughly constant at 5.3% for retirement periods between 25 and 40 years. And even for shorter retirement periods below 20 years, it's not far below 5%. So this Golden Butterfly investment strategy backtests very well. Now, if you cast your mind back to that dividend fund that we saw first of all, the dividend yield there was just 2.8%. And consequently, we had to put well over $1 million into the fund in order to generate that income. And the amount we had to invest was so high because the dividend yield was very low. Now, if instead we actually sell proportions of the portfolio every year with that Golden Butterfly portfolio, because the perpetual withdrawal rate is so high, 5.3%, we need to put much less into the fund. This is well under $1 million. So it really pays to design your investment strategy very carefully. And using backtesting tools like portfolio charts is a great way to do that. And it also lets you change the country in which you're based, because of course the rate of inflation depends on where you live. And if we choose the United Kingdom, the perpetual withdrawal rate is much lower. In fact, it's just a little over 4% for a 40-year period. But with this tool, you can actually change the weights. You can fiddle with them to see what effect it has on the perpetual withdrawal rate. And if I use this portfolio, which is 45% large cap value, 45% small cap value, and 10% gold, we actually get a pretty good perpetual withdrawal rate now. So if you are planning an early retirement investment strategy, tools like portfolio charts are incredibly useful. Now, a good starting point would be something like Golden Butterfly, but you can always experiment and come up with your own strategy. Maybe you'll find one with an even higher withdrawal rate. But if you do, why not share it in the comments beneath this video? I'd love to hear what you discover. In fact, building an early retirement investment strategy would be a great topic to discuss on the chat application Slack, which you could do as part of our Patreon community. Now there you could ask me questions or other members of the community. They often have really interesting insights on any topic, and you get to vote on members only videos. And then you'll only be able to see those if you're a member. Now, if you do want to learn more about that and how to sign up, just click on the link beside me and in the description below me. And as always, thank you for listening.